market movers. This is The Pulse with Francine Lacqua.
Well, good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London. Now, another packed show today. Later in the hour, we're live from ADIPEC with OPEC Plus deciding to pause higher production. But first, it's going to be a hectic week with earnings season here in Europe after some strong tech earnings from the U.S. We've also got a rate decision from the Bank of England and trade tensions between the U.S. and China appearing to be easing. So let's bring everyone together. Karim Chedid, head of the EMEA investment strategy at BlackRock. We have Tim Craighead, global chief content officer at Bloomberg Intelligence, looking at a lot of the earnings, and Brendan Murray, who leads our trade coverage. Again, he hasn't slept in 12 months. Brendan, I mean, let's start with you. It's like, you know, we had the U.S. and China really at loggerheads. Now things are easing. To what point can they ease?
Yeah, exactly. This is really the beginning of a new phase of the U.S.-China relationship, or at least that's what Beijing and Washington hope to accomplish. What they've done is China's agreed to let the rare earth minerals and magnets that are so important to U.S. industry, European industries. China's agreed to let those flow again without so much restrictions. And the U.S. has agreed to withhold the escalation of its entity list that captured a lot of Chinese companies. And that really annoyed Beijing and led to this recent flare-up. So the deal that they're starting with today, the White House released a statement over the weekend, lays out what each side agreed to do. And it's going to be based now on monitoring and compliance. And one of the things to keep in mind is a lot of these measures that both sides have agreed to suspend could be brought back relatively quickly if either side decides to escalate.
I was going to ask, Brendan, I mean, is this a sustainable way forward? Do we know, I mean, the two leaders had a call, they seem to get along, but do they need each other actually or could it flare up again?
Yeah, it's a very fragile truce that they've negotiated, but China has started to buy American soybeans. Soybean prices have rallied over the past few days. So the steps look to be headed in the right direction. But again, it's a very hit or miss kind of thing. It could go south very quickly if one side views the other as not keeping up their end of the bargain.
Karim, I mean, I know there's been quite a lot on central banks. There's still the Bank of England actually on Thursday. But has the market largely moved away from these tariff concerns?
So I think I will give you the on the one hand, on the other hand, the usual answer. Because on the one hand, yes, it's a truce, as my colleague just said, but it's not a total resolution. And so, yes, markets have seen through some of these tariff concerns. But then when you look at something like gold, which you were pointing out to in your intro, gold is still, recovering from some of the pullback over the past couple of weeks that was driven by some of that froth, especially on the retail side. It's still going into strength, and we still see that demand coming through in the ETF flow picture and also in EM central bank purchases. And I think that's a bellwether to the concerns are not entirely disappearing.
What exactly was happening with gold? How much of it was longer-term de-dollarization or moving away from U.S. assets and therefore central bank buying? And how much of it was actually just trying to do something with all this U.S.-China tension, but also U.S., the world tariff tension?
It's both, actually. The first component, which is that moving away diversification of reserves in EM central banks, is not a new story. We're in the third year of this happening, of this gold purchases from central banks coming through stronger and stronger year after year. And we see this as a persistent driver that puts a floor on the gold price and how much it could fall in any dips. But then the other component you mentioned, which is more around tariff concerns, more around volatility, diversifiers in portfolios because of rising and less reliable stock bond correlation, those come through in the flow picture. And those have pared back a little bit in the past couple of weeks, but I wouldn't bet on that pair back lasting.
Are we expecting, Brendan, a lot of tariffs to come down with other nations as well? I know Mark Carney had to apologize over a tariff advertisement. There's also the Supreme Court.
Yeah,
right?
Exactly. The all eyes this week are going to be on the Supreme Court arguments that are going to take place. Yeah. They're going to start around mid-morning in Washington on Wednesday. We're not going to get a ruling quickly. It may take weeks or a couple of months for the court to come back with its ruling. But basically, the legality of President Trump's tariffs, or 2/3 of them, these reciprocal ADIPEC tariffs, are being called into question as to their legality. Trump has lost the lower court cases. They're now at the Supreme Court, which is going to decide, do they give the president this emergency powers to impose tariffs at will?
Tim, we're drowning in earnings. I mean, there's so many earnings left, right, and center. And again, a lot of them are beating expectations. I mean, depending on the kind of industry you have. But it seems that tariffs doesn't really, if you count the words on tariffs and trade, it doesn't really show up in earnings calls so much.
Well, you know, it's an interesting thing. Take a step of where we are right now. We're roughly 2/3 of the way through the European earnings reporting period. We're running 52% win, 30%, 29% lose. That's a big percentage for European earnings. Quite typically, the U.S. is far higher. They play the game more aggressively in terms of managing expectations. But you're right in that if this was such a big deal, we wouldn't see this kind of effect. That said, going through the transcripts of third quarter earnings so far, there is an interesting ongoing sort of mantra about tariffs, as you would imagine. There are some who are able to cover it through pricing, but there are a lot who are concerned about demand and demand uncertainty and costs. It's roughly even from that perspective. It's not overwhelming one way or the other.
I love these boards. So you're looking at European earnings, you know, what we have tomorrow, then Wednesday, Thursday, Friday. I mean, do they come from a lower base in terms of expectations, which is why they beat, or is it actually that we have a much stronger economy than expected?
It's a little of both. There's no doubt that expectations were cut as we went through the first half of this year. You look at the earnings trajectory in terms of expectations for Europe versus the U.S., and there's been a divergence. That said, you know, we look at what's going on this week. I think it'll be another one of those interesting finger on the pulses. It's 80 companies that are reporting across Europe. You've got AstraZeneca, which has nothing to do with this cycle. It's one of the best growth stories in global pharma. We're looking for the potential for positive revisions, but you offset that with Novo Nordisk, and we all know the problems that have had there. That'll be quite telling. You've still got Vestas coming, which clean energy ideas have been on a storm. You've got Leonardo, which is a momentum play in the world of defense. So there's definitely some strong companies, or what we would expect to be strong earnings coming through this week.
And you have some good analysis, Karim, because you basically look at the median price reaction to results. In Europe, it's been the most positive in 2 years, but still Europe is not doing as good as the U.S. Exactly.
So if we zoom out and look at the bigger picture, Europe is on track to deliver flat earnings growth this year, whereas the U.S. is delivering double-digit, 12% earnings growth. I'll make two observations there. In Europe, I think there are big opportunities, but in sectors. So I think here sector selectivity in ETFs or even active management really plays a role here, because you look at financials. I mean, financials are really concentrated there in terms of where the good earnings are coming through, but on the broad level, we're still at that flat picture. We are also tracking this repatriation trade in Europe, where European investors are bringing money back into European equities this year, and this year is a record for ETF flows back into European equities. So those flows need to go somewhere, and I think that's where the selectivity comes in. The second observation, very quickly, on the U.S. is that earnings are broadening out. This year, we're seeing, outside of Mag 7, outside of tech, we're seeing 9% earnings growth. Last year, that would have been flattish. The year before, it would have been negative. So there is breadth coming through in earnings in the U.S., and I think that's good news for U.S. equities.
Do you worry about tech? So the best definition of a bubble that in my life I've ever heard was someone this morning tell me actually a bubble is actually owning the things that you would get fired for not owning. And so it kind of comes too late.
I mean, sure, there is a consensus, widely held consensus view around tech, but so far it's backed up by fundamentals. It's, missing out on tech returns is a big thing. You would probably underperform your peer group if you don't own those stocks that are rallying and that are driving, the performance is concentrated. But I think this earnings breadth piece, whilst performance is still concentrated, creates an opportunity to invest in those areas where earnings are starting to grow, but prices have not caught up yet.
Just to be clear, I mean, the trade war that's easing off between the U.S. and China, I mean, they're still going at it for AI, right? The tech race.
Oh, absolutely. Yeah, I mean, that is at the heart of what China wants from the U.S., high-tech chips and so on. I think where the rubber meets the road for President Trump on these tariffs is, despite these earnings beats that we're seeing and the positive signals from Wall Street, there is a slow corrosion of businesses, smaller businesses, that aren't able to adapt as quickly. And what did we see Congress vote on last week while the president was in Asia signing these deals? They voted against his tariffs, and I think there's a political blowback yet to be seen on the White House, because there are a lot of smaller businesses that are really getting hurt. That these are the companies that are bringing the case that's going to the Supreme Court, the ones that cannot stay in business with the current tariffs as they are in place right now.
And Tim, ASML is like almost the perfect package, right, to understand all of this.
It is. I mean, think of it as the confluence of AI. You couldn't do AI as we're currently thinking about it if you didn't have ASML making the equipment that NVIDIA uses to make the chips. By the same time, it's right in the forefront of, can you sell that kit into China? And if you can't, what's China do in terms of an alternative, chip idea beyond NVIDIA's accelerators? So it will stay proximate. So far, so good, but it's clearly in the target zone for that debate.
And it's central banks. So we have 2 minutes to talk about all the central banks. Karim, there's a real problem for the Fed that I think they just don't have the data.
Sure.
And actually, Jay Powell was quite clear on that.
Yeah, I mean, but then we also did have enough signs from alternative data around labor market cooling that the market, leaned into that Fed rate decision last week. So it didn't really spook market for good reason. As we look forward, we look at the market pricing of the Fed rate path into end of next year, and it does look excessively dovish as it stands, even with the dark info in terms of not having lots of data, because we do see inflation potentially inflecting higher for 2 reasons: the tightness of the labor supply because of immigration policy, and secondly, the fact that companies have not really passed through the pickup in costs from trade, from tariffs yet. But now that we're getting a bit more certainty, not total resolution, but a bit more certainty on where tariffs are landing, we could start to see that pass-through come through, which is inflationary.
Do we need to talk a lot more about the U.S. government shutdown? Because of the news cycle, it's just investors are not really focused on it.
Well, I think here it's good to focus on the bigger picture. What is this is a symptom of? It's a symptom of the broader fiscal concerns. These fiscal concerns are not exclusive to the United States. They are a universal problem across G7 economies. And the investment conclusion from that is that we're likely to still see steeper yield curves from here. The long end coming under pressure is the big investment conclusion.
Okay. Thank you all for joining us. Karim Chedid, head of EMEA Investment Strategy at BlackRock, Tim Craighead, Global Chief Content Officer at Bloomberg Intelligence, and our very own Brendan Murray, who leads our trade coverage globally. Coming up, how emerging markets are riding the AI boom. We'll discuss all of that with Giulia Pellegrini from Allianz Global Investors. That's next, and this is Bloomberg.
We know that Russia cannot export about 3 million barrels that before they were exporting to China and in India. That is something that is going out of the market. So it's not considered in this oversupply. So I think that we have to be very cautious, because if you say that there is an oversupply from one side, you say that we are not investing enough on the other side, you reduce investment, then what you produce, a peak in the oil price, and that is not good for the society.
Yeah. Well, that was the Eni chief executive, Claudio Descalzi, speaking to Bloomberg at ADIPEC in Abu Dhabi. Now, energy producers and emerging markets are riding the AI boom with stronger commodity demand and tech exposure, of course, helping to drive gains. EM stocks have rallied every month this year, the first time that's happened since 1993. Well, for more on this, we're joined by Giulia Pellegrini, emerging markets portfolio manager at Allianz Global Investors. Giulia, thank you so much for joining us. Now, first of all, it's really quite incredible how the emerging markets have had a good ride. Now, I know it depends on the pockets of countries that we're looking at, but also the amount of debt that they've issued this year.
Yes, that's been a remarkable ride for sure, especially considering the fact that it's really mostly come since the 2nd of April, the famous Liberation Day. Emerging markets have had a really solid ride, and we think it's due to a number of reasons. We've obviously seen a very supportive global backdrop, as you noted, investment all over the place. We are seeing macro data in recent weeks that point to solid growth globally. And also a December cut by the Fed we think is still in play. So that's very supportive for emerging market as a backdrop. On top of it, you have very solid economic fundamentals by these countries on the whole. The IMF has just come out with its World Economic Outlook, really highlighting the resilience of this asset class as a whole. And then you have very compelling valuations. You have high yields by historical standards, much higher than what, for example, a developed market type of investment can offer you. So we're seeing a lot of interest by investors to diversify their portfolios, and that combination of a high carry and stability and solidity in the economic fundamentals of emerging markets bring together a carry to vol ratio that is really compelling for EM at this time. And last not least, you obviously seen inflows that are basically providing even more of a flywheel to that investment thesis.
So Giulia, what countries actually specifically do you look at? And again, is it also because of what's happening with the dollar that is a welcome boost to a lot of the emerging markets?
Of course, the dollar has helped tremendously this year in terms of solidifying the thesis for investing in emerging markets, EM local debt especially. We're looking at a broad range of countries. We're seeing US IG investors looking to diversify their portfolio away from just US opportunities into IG opportunities in emerging markets. The asset class is on average IG rated, we should remember that, and there are opportunities from Mexico all the way to the Gulf countries, all the way to Indonesia. But we're also looking at EM local dollar, EM local currency opportunities precisely because the dollar is being in favor. We think it will continue to be so despite some short-term wobbles perhaps. So the EMFX asset class has been doing very, very strongly. And we'll look particularly at the high yielders in that space, at the South Africas, at the Turkeys and the Colombias, etc.
How much, were you like actually some of the emerging markets? I know you were looking, for example, some of the investment-grade issuers, such as Indonesia and Mexico, also making about 80% of that issuance. Mm-hmm. How much does that have to do with, some of the structural reforms that they've put in place? Because they've been hit quite hard by tariffs and trade.
They have been, but by and large, what we're seeing is that these countries have spent the period after the pandemic to really do their homework, shall we say. So they've improved their economic fundamentals. Again, the IMF has praised their policy frameworks. They built more resilient economies. Again, it's a large generalization over a large asset class. We're talking, though, about 70-odd countries. So there's a lot of options there to diversify your portfolios into countries that have done their work. And that goes all the way, again, from a Mexico to a South Africa, all the way to Asia again. So the opportunities are there to build a very diversified and resilient portfolio. We've seen issuance coming from many of these countries, over $250 billion this year, 2/3 of that from IG-rated countries, but also frontier markets are coming back to the market.
Giulia, when you look at some of how you build your portfolio, how much diversification do you want in there? And again, if you link it back to U.S. China and the fact that trade tensions are easing, what does it mean for the emerging market space?
Sure. I think this period has been really fantastic for us because we have on one side a very resilient and diversified asset class, again 70-odd countries to pick from, and at the same time, because there's been some volatility on the back of trade-related headlines and the like, we as active investors have been able to really pick and choose the bets we want to put into our portfolio. So the combination of that has been really compelling, and we're seeing the interest in terms of flows returning to the asset class after about 4 years of seeing outflows consistently. So it's a nascent trend, but one that we think will continue because of this interest in diversifying portfolios.
What do you do with Argentina?
Argentina is a very interesting country. It's seen a lot of movement in the last 2 months alone. So it's one that we still look at with interest in our portfolios. We're still constructive. We've seen President Milei, of course, getting a resounding victory at the midterm elections that will allow him to move ahead with his agenda. What we think we'd like to see from here is more of a focus on rebuilding those FX reserves, more of a focus in reviewing the FX ban that he's got going. And I think that will bring getting the country onto an even more solid path. So we look at it very constructively still.
Giulia, when you look at what the Fed does, and again, they were quite clear, last week, and actually the market believed, despite there being these dark points where we don't actually have the data, depending on what you're expecting from the Fed, how much does that move some of these countries?
Well, obviously, a Fed continuing to ease helps the emerging market asset class with a solid economic backdrop and easing on the developed market side. That helps our asset class, but that's not the only point that underpins the investment thesis for emerging markets. As I mentioned, economic fundamentals play a huge role. The willingness to diversify portfolios away from U.S. assets, valuations extremely compelling, and on the whole, trade headlines that have proven eye-catching at times, but then also we've seen moments in which the powers that be are willing to sit around the table and find a solution. So we're rather constructive, the asset class.
Giulia, thanks so much for joining us. Giulia Pellegrini, their EM portfolio manager at Allianz Global Investors. Now, we've had big news from BP this morning. It's agreed to sell its stakes in U.S. shale assets to 6th Street for $1.5 billion. The CEO is currently speaking on a panel at the ADIPEC Energy Conference in Abu Dhabi, moderated by Bloomberg's Jumana Bersecci. Let's listen in.
People don't have access to electricity. On top of that, 2 billion people don't have reliable electricity. And then when you look at grids infrastructure, very outdated, some as old as 50 years old, they will not be able to take the load of the power demand that we have today. Now, on top of that comes this whole AI power demand. So this is where we're seeing data centers, electrification of industries, grids, mobility. So when you put that on top, we've got a new reality. And that's why His Excellency Dr. Sultan mentioned this morning, it's now about energy addition. And so when we look at it from that perspective, I think the pragmatic pathway is keeping the lights on, powering the AI economy, and making sure no one gets left behind.
What do you see as the biggest drivers of energy demand in the coming years?
So there's two, of course, human progress. We're going to be 10 billion people in the next decades. And then there's the AI power demand that's coming. When you look at just data centers in itself, next year, we're going to be doubling the power demand just for data centers. And when you look at the numbers on that, that's basically the power demand of Japan, adding that to what's already needed in the pathway that we're on.
Mari, let me ask you about BP, because in the past couple of years, there's been a change in strategy, almost a walk back from some of the more ambitious targets that you've set on the low carbon strategy side of things. Walk us through that journey, and also why or where that fits in an environment where still we talk about a move towards decarbonization.
Sure, thank you. And first, thanks to the host nation, Abu Dhabi, Excellencies. Thank you for your patronage. Thank you for your support here. And we're really pleased to be back in Abu Dhabi. 85 years in the country now, and I like to say looking forward to the next 85. We have had a shift in strategy recently. When we set out our strategy back in 2020, the world changed significantly since that time. We obviously had the war in Ukraine. We've now had the birth of the hyperscalers. And what we find is, as I go from country to country and meet with the leaderships of nations, the needs of nations have changed substantially over time.
Good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London, and these are your top stories. The trade war between the U.S. and China continues to cool, with China suspending rare earth export controls and the White House further easing tariffs. Oil in focus as OPEC Plus hits the brakes, saying it plans to pause output hikes from next year. Plus, Ryanair lifts its passenger growth target for the year as it reports second quarter earnings that beat and receives aircraft from Boeing early. Now, oil is flat today after several sessions higher. This after OPEC Plus said it plans to pause output increases in the first quarter of 2026 following another modest hike for next month. The organization said it would raise production by about 137,000 barrels a day in December, matching increases scheduled for October and November. Now, for more on this, let's get to James Heron from Bloomberg. He joins me now. James, thank you for joining us. I mean, first of all, this was a bit of a surprise.
It was, yeah. They've been sticking to the gradual increases every month and since April, so this is the first time they've paused. It's not a huge change. It's, they're not cutting production or anything like that. They're just taking a breather to assess the market. And what they say about the first quarter, where demand typically dips anyway, is true. So it makes some sense. But at the same time, it is a surprise, and it is a modest change, of course, from them.
So what does it mean for the price of oil, given the also extra sanctions on Russia?
Yeah, there's still a lot of uncertainty there. I mean, as you said, the price reaction was pretty flat today. The big question is how much oil do these sanctions on the two Russian oil producers take out of the market? Russia has proved very adept at skirting these sanctions. Maybe there's some ways they could do that. But then the US seems to be keen to enforce them more at this current stage. So, yeah, it's really hard to say at this stage. And again, maybe that's why OPEC has paused rather than, taken a sudden turn in a different direction.
James, do we know why? I mean, is this basically an acknowledgement from OPEC Plus that there's going to be a sizable surplus next year? And do we know, if there is something like that, why?
They're certainly not saying that, and the minister from the UAE this morning said, they're happy with the market. Their own forecast numbers, which are very different to other forecasters, don't suggest that. But I think inevitably the fact that they've made this decision suggests that they're aware of the other forecasts out there. And if you look at, say, the International Energy Agency, they see almost a historic surplus next year.
So interesting. James, thank you so much, as always. James Heron there, of course, our reporter here in London on everything to do with oil. Now, to look at how that is likely to impact on European integrated energy companies, Lydia Rainforth, head of European Energy and Energy Transition Research at Barclays, joins us now from ADIPEC in Abu Dhabi. Lydia, thank you for joining us. So, first of all, when you look at possible surpluses, how do you see the market going? And then we'll get into individual companies.
Yeah, so I think for me, on the oil market side, what we've seen from OPEC this morning is eminently sensible. Demand, as James said, typically drops at this time of year. And so really we're going into a period where you'd expect to see inventories build. And rather than play into that dynamic and that narrative of there being a glut, they really have taken a step back and gone, let's just let the data play out. As we go into 2026 and further into it, there's actually limited non-OPEC supply starting to come through. And I think that's going to make a real difference to how people see the spare capacity within OPEC as we get into the middle of next year. But I go with, we've probably got a period of resilient prices near term, and then we start to rally longer term for us.
Lydia, of course, we need a lot more energy to power a lot of the data centers than will power what we use in terms of AI. If you look at the major integrated European companies in that space, who can capitalize the most on it?
So there's a huge amount going on, and it's been fascinating being here at ADIPEC, listening to all this. And I think it was the Microsoft CEO was saying that actually the period or the constraint at the moment isn't GPUs, it's actually energy and space for data centers. And you've got both here in the UAE and the Middle East. And so we're probably expecting energy demand from data centers here in the Middle East to grow about 8 to 10% a year. So that's a significant opportunity here in the Middle East. But also you're then seeing where can those companies really start to take advantage of that as we come into the sort of over the next kind of 5 years. And for me, it is the bigger companies. Are we looking at things like ADNOC Gas? Yes. BP, Shell, Total Energies. All of them have very clear plans that play into gas and play into that growth side. And as one of the ministers put it here earlier, it's for the first time power is knowledge, and there's a willingness to pay for that in a way that there hasn't been before.
Lydia, when you look at some of, for example, the ones that really stand out, I know you mentioned Total Energies as one of them. Is it because they have first mover advantage for some of what they're actually reinforcing or some of the things that they're distributing, or why does it make it better than a BP or a Shell?
So So if I think about TotalEnergies, they've been incredibly consistent in their strategy through the last 5 years. And so they went in cautiously. They built an integrated power business that is actually making money. And I think that idea of targeting a 12% return on capital is something that really the other companies slightly missed a little bit. That idea of you need to do it stage by stage and prove that you can make money. And by combining the need to produce electrons with the idea that you need reliable power in the form of natural gas, that's an area that Total have taken advantage of, and they were very early movers in buying integrated power plants natural gas-fired power plants over in the US. They're doing the same in some of the European continents, and it's that combination that really matters. You've got to be flexible in this world. If you don't have that flexibility in power generation, you're not going to be able to take advantage of the movements in the markets. And that consistency in the way that Total has driven it has been really made a difference. We heard just from the BP CEO a little earlier that the world has changed since 2020 when they set out their strategy. So it really has been a case of where the pace at which the companies have gone has varied, and TotalEnergies has proved time and time again that they've made it work. And I think that owes a lot to the CEO, Patrick Pouyanné, and the team that they've put in place there.
Lydia, what can you tell us about gas prices, and especially the oversupply that could be coming from the U.S. and the impact this has on energy and gas prices in Europe?
Yeah, so there's been a lot of theory. We have a lot of supply coming on stream in LNG. And we've got a lot coming from the US. We've got a lot coming from Qatar. And that really hits us 2027, 2028 at the point coming through. And that leads to a lot of discussion as to where does pricing go? Do we end up with parity with US LNG, which would probably put us in that $8 to $10 per MBTU range compared to the $10 to $12 per MBTU that we are now. And then the question comes back very much to your earlier question, Francine, about AI and how much power does that need? And Shell has set out a surge scenario, which if we can deliver all of the demands for AI that is required, we actually may not end up needing in an oversupply situation. So it's that question of does supply create its own demand on LNG? And I'm very much in that camp. I don't think we'll see a collapse in prices. I think you'll see a period where prices soften a little bit, but that $8 to $10 is a pretty reasonable range. And if I think back to where we would have been pre the Russia invasion, that would probably have been in that $5 to $6 level range. So we are still in a world of higher energy prices than we might have been used to being 5 years ago.
So interesting. Lydia, thank you so much for joining us. Lydia Rainforth, there, head of European Energy and Energy Transition Research at Barclays. Now, global markets betting against one of President Trump's biggest election pledges. The president famously promised to drill, baby, drill when it came to his enthusiasms for oil and gas. But U.S. financial markets are favoring renewable energy over fossil fuels, with global investment for new renewable energy development reaching a record $386 billion during the first half of 2025. Well, the findings come from Bloomberg's editor-in-chief emeritus, Matt Winkler, who's with us now. Matt, first of all, congratulations on an interesting piece where you kind of put together a lot of what generals were thinking about where the energy market for the U.S. goes. So why did you write the piece? Is there, you think, a misconception about renewables?
Well, there's certainly not a misconception among investors, because investors, if we go back literally a year ago, that was when Trump was elected again. And that is, of course, if you like, the beginning of let's measure performance. And in that period of a year, renewable energy represented by, say, at least 24 companies that are publicly traded has absolutely crushed not only traditional energy, which, by the way, lost money, lost 3% in this period. But if we looked at renewables as a group, they gained 56% since Trump was inducted into the White House again. And if we looked at solar, that was a return of 26%. And now if we look at the past 6 months, now Trump is in office, he's had a chance to impose himself on everyone. And once again, the score is obliterating traditional energy as an investment, here are some of the figures. You've got 11% and 24%, for example, for traditional energy and the S&P 500. But if you look at renewables, it's 85%. And solar, it's 88% in the past 6 months. And then there's this company that, among several that we've looked at, called Bloom Energy, and they're involved in storage, energy storage. And they're up 700%. So it's not even close.
So, when you look at what the president said, which you mentioned in your story, drill, baby, drill, is it just because the train had left the station in terms of renewables? Actually, they become cheaper, so people want to be part of it no matter what federal policy is.
Well, he likes to criticize his predecessors, and the most recent one in particular. And, the 4 years of the Biden economy was an emphatic global if you will, shift to clean energy. And that's not an easily reversible trend. It's been going on for actually more than a decade and a half, but it really was pronounced in the past 4 years before we got to where we are today. And that's a trend that's not going away. The cost of clean energy keeps going down. The cost of drill, baby, drill isn't going anywhere. So if you just look at that, and if you look at the sales growth of the companies that are in renewable and solar, the analysts who submit their forecast to Bloomberg show us that we're going to look at double-digit increases in sales growth for clean energy, whether it's renewable or solar, whereas you're going to get something close to very pathetic single digits for traditional energy. So that's the outlook, and the market is essentially completely ignoring what he's saying.
And Matt, what I also like in your piece is that you basically look at what's cheaper, right? I mean, there are many forms of renewable energies, and so when you look at the companies, who comes up trumps? Is it solar? Is it wind? Is it hydrogen?
All of the above.
So it doesn't make a difference. Wind is still quite expensive.
Yeah, but even there, the costs keep getting depressed, if you will, relative to where they've been historically. So, this is a technology that is in its infancy, really, the clean energy technology. And it's only going to accelerate with artificial intelligence. It's only going to get better. One example, of course, is that these companies that we're talking about, they're all in California. California is the fourth largest economy in the world, okay? It's getting bigger, not smaller, okay? It's getting bigger relative to every other economy. Why is that? Because what's in California is between your ears.
So interesting, Matt. Thank you so much. Matt Winkler there with a great story that I urge everyone to see either on the Bloomberg terminal or also on our website, our editor-in-chief emeritus, Matt Winkler. Now, let's also listen to the panel talking about where, we have the CEOs of Shell, we have the Total Energy CEOs there, Mr. Patrick Pouyanné, talking about what the future looks like. Let's have a listen.
We are using linear program, which honestly are not the best of the. We can do better, I'm sure. And I think that from having access to the data with this machine learning and all this, by the way, it's more about machine learning than really LLM when we speak about AI in our industry, manufacturing part of the company. Yes, we can be smarter and we can run better our plants and deliver more energy. It's also contributing, by the way, to the less emissions of our roadmap. Because if we run better our plants, if we manage to fine-tune the way some equipments are really used, rotating machines, etc., we can use less energy, having less emissions. So it's contributing to both. Then you have areas, again, my electricity business, where obviously AI is helping a lot because it's electrons is native to digital, is native to electrons, and power, like you say, power is knowledge, or what was said this morning, but I think it's clear in that business, forecasting weather to optimize renewable assets. I can tell you, it's a huge area of very modelization, AI, and we inject.
Well, we'll leave that panel, but you can continue watching on the terminal. Just go to Live Go. Coming up, Ryanair forecasts stronger than expected passenger growth after receiving planes from Boeing early. Details are next, and this is Bloomberg.
we're at a dawn of a very exciting growth period for Ryanair. The good news as well this morning is we've hedged fuel out into next year. So we were able to jump on some of the recent fuel weakness. This year we're hedged to March 26 at $76 a barrel. This morning we've announced we're now 80% hedged to March 27, but at just under $67 a barrel. So about a 10% saving on our fuel costs.
Well, that was the Ryanair CEO, Michael O'Leary, speaking to Bloomberg after reporting second quarter profit that beat estimates. And Ryanair expects to exceed its passenger growth target for the full year with the help of quicker Boeing aircraft deliveries. Bloomberg's aviation and space analyst, Kate Duffy, joins us now with the very latest. Kate, good morning. So, look, good earnings, actually. Good news, good earnings. Michael O'Leary on great form.
Yeah, it's a solid set of numbers. I mean, they've announced an interim dividend. They've also, up with their profit after tax on the previous year. And as you say, they've also lifted their passenger forecast goal for this year. So they were predicting 206 million and now they're looking at 207 million. And this is really off the back of strong demand, but also some early Boeing aircraft deliveries. And it's important because they previously cut this passenger forecast goal earlier this year, a couple of times actually, and that was off the back of late deliveries. So we're really seeing some progression at the plane maker, and that's trickling through, obviously, into the customers.
Okay, what else did we hear, actually, from Michael O'Leary?
Well, we heard that obviously Boeing, these early deliveries are coming through. Also, capacity remains constrained at the moment. So although Boeing has made signs of progress, it is still behind, as well as Airbus. There are engine supply shortages as well. What else did we hear? We heard that fares are strong, actually, going through. They're also going to have some reasonable profit growth as well, although he couldn't really put a number on that, but we're waiting to see what that could be. And also strong passenger traffic numbers going into next year as well, so maybe 215 to 216 million passengers next year. So really interesting sort of forecast for Ryanair going forward.
Kate, so what does it look like in terms of medium to longer term outlook?
Well, in terms of fares, I mean, they're looking strong at the moment. He did say that it is a challenging outlook for the second half of this year, just because last year was quite tough for them in terms of the online travel agent dispute and all of that. But they are on track to get all of their Boeing deliveries by next summer. And this will obviously make a big difference with sort of their network growth, their passenger growth, also they're getting their MAX 10 deliveries, hopefully on time. They confirmed today, Ryanair, that Boeing are scheduling the certification for mid-2026. They're hoping to get the MAX 10s in about 2027. So it's all on track. It's all looking positive. So let's see what the sort of next year holds for Ryanair.
And Kate, I mean, can you transpose this to the airline industry in general? They feel actually that they're in a good, strong place overall.
Yeah, absolutely. I mean, every airline's in a different position. You have Wizz Air that's struggling with engine issues. Other airlines are struggling with aircraft shortages. Obviously, Ryanair are one of the most outspoken critics of Boeing, or they were previously, and they really held their feet to the fire in terms of late deliveries and this stunting their growth. But recently, they've visited Boeing. They've seen improvement. They're really happy with the quality. They're not seeing any defects in the aircraft. And so, yeah, they're reporting really positive things from the plane maker at the moment.
Kate, thank you so much for joining us. Kate Duffy there, our aviation and space analyst. Now, Bloomberg has learned that Pony AI is set to raise $863 million in its Hong Kong listing. Sources say the robo-taxi firm's listing has attracted ride-hailing giant Uber, which was in talks to invest about $100 million in the share sale. Well, proceeds from the listing will fund large-scale rollout of its level 4 self-driving tech, in addition to further research and development. And Berkshire Hathaway's cash pile surged to a record $382 billion in the latest quarter as earnings jumped at Warren Buffett's conglomerate. The firm's cash hoard grew as Buffett avoided deals during the quarter. Now, insurance underwriting profit more than tripled. Berkshire also declined to buy back shares for a fifth straight quarter. And France is launching closed-doors talks to rescue its 2026 budget amid a standoff that could topple the Prime Minister Sébastien Lecornu. The political gridlock has driven French bond yields to their highest in months and widened spreads over German bonds, while Lecornu has ruled out using Article 49.3 to push the bill through, adding to investors' jitters over efforts to curb Europe's largest deficit. Now, the UK Chancellor Rachel Reeves is considering new taxes on the wealthy to plug a budget gap of as much as £35 billion. Well, Bloomberg understands that the options being weighed include an exit charge for rich Britons leaving the country and higher levies on luxury homes, both moves that could reshape property and capital flow. Now, for more on this, I'm joined by Joe Mays, our UK government reporter and author of Can You Run the Economy? It's Your Turn to Be Chancellor. It's perfect. I mean, your book, Joe, could not come at a better time because Rachel Reeves is being faced with very, very difficult choices. Through our own reporting, what do you think will happen at the budget?
Yes, I give you an option in the book to levy a wealth tax. I think that's the kind of discussion that is happening in quarters of government at the moment. I mean, Rachel Reeves has said that she wants those with the broadest shoulders to bear the burden of these tax rises that are necessary, as you have just described. She has this black hole largely driven by a downgrade in productivity estimates for the economy from the Office for Budget Responsibility, and so she has to find the money somewhere. She has this manifesto pledge not to increase taxes on working people, especially income tax, VAT, national insurance. So that's why we are talking about things like an exit charge when you leave the country, paying perhaps 20% tax on your holdings. We are talking about things like larger properties, paying more in council tax, perhaps. But her problem is that there's a large sum of money to be raised, and it's not clear how much these kind of narrow taxes on the wealthy would raise. Indeed, there's always the capital flight question. Will this push wealthy people away ahead of the budget? That's a concern. So, yeah, she's got a lot of money to make up.
Yeah, it feels, Joe, that these are much bolder and more progressive tax changes than maybe a lot of investors were expecting.
Yes, I think that what Reeves is going to do is use the backdrop of this big OBR downgrade, which she's going to blame on the Conservative Party, the austerity years, Brexit, and use that as political cover, really, to raise tax in a pretty significant way. There'll be some spending cuts as well, I expect, but tax will likely do the heavy lifting. And yes, she'll use that as a pretext for a pretty bold budget. We're expecting to be her saying making the tax system fairer. And for me, that's code for making the rich really pay more. That's a kind of that Labour value she wants to see happen. And that's where we're heading. A pretty big budget, largely driven by tax rises to fill that black hole.
I know you touched on it, Joe, and it's the impossible question, but we have definitely seen a number of high-profile investors and entrepreneurs quitting the UK after the non-dom rules changed. I mean, how difficult is it to map out what these tax changes mean for wealth exodus?
It is difficult, often because there is a lag in the data. So you can't see immediately with official statistics what is happening. You have this anecdotal evidence, which we at Bloomberg have been compiling extensively of the wealthy going. I mean, when I speak to the Chancellor, when I speak to the Treasury, they are pretty confident about where it stands. They think that the data isn't actually that bad and that the wealth exodus is not as severe as you might expect given the press coverage. But it is the big question, right? Rachel Reeves has this tension between wanting to get the public finances in order, which means raising taxes, but that bumping up against her mission to grow the economy, make Britain an attractive place to invest. So she's constantly trying to manage this tension, and we'll see it at the budget again when we see these tax rises. It'll be a wait and see. Does the wealth exodus exacerbate? Does it get worse? We'll have to wait and see.
Meanwhile, Reform and Nigel Farage, who's definitely leading in the polls, I mean, can he stick to his promise of cutting taxes if he comes into power in 4 years?
We're expecting Nigel Farage to make a big speech today where it seems like the message will be they're drawing a line under their 2024 manifesto and pivoting their message to one of saying we can't necessarily promise big tax cuts immediately, and what matters is the state of the public finances at the time. So that is a shift from Reform. I think they see a vulnerability in their position and not being seen to be too credible in economics, and that's where Labour keep attacking them, and indeed the Tories. So I think Farage is trying to put them in a more reasonable position on the economy, and they hope that will kind of continue to bolster their support, which is already very high. They're riding high in the polls.
Joe, thank you so much. Our UK government reporter, Joe Mays. Now, the Fed Governor, Stephen Mirren, is on Bloomberg surveillance. Don't miss that interview at 12 p.m. London time. Up next, a Bloomberg Brief with Vonnie Quinn. This is Bloomberg.